Now, the Foundations of Financial Management syllabus takes a broader look at sources of finance. This is in the context of the greater world of finance. So we have to really be able to take a very senior view of markets and understand what's out there in terms of choices for companies to be able to identify sources of financing their business. Let's start with macroeconomics. It's important that the candidates be, and of course all business managers be, economics literate up to a certain degree. In other words, from a broad strategic point of view, businesses should be able to estimate what the demand levels are likely to be for their products. Comments made here to show some topicality that there's no immediate return to pre-crisis levels of demand likely. In other words, after the financial crisis and the economic crisis starting in 2008, many economists believe that this is not simply a cyclical downturn, this recession that we are experiencing across the world today, but that in fact there are structural changes that are taking place that businesses have got to be able to interpret properly, so they don't just automatically think, oh, we should have an enormous capacity for automobiles because we know that automobile demand will recover again, unless, of course, one is targeting the Chinese or the Indian markets. Okay, the other thing that business managers need to know about is how to interpret government policies, because the government still has a great say in the conduct of economic affairs in countries across the West, and of course in emerging markets as well. Particularly, people look to the Federal Reserve Bank in the United States to understand what the impact will be of monetary policy. You may have read about the tool of quantitative easing, which has been taking place in order to pump more liquidity into the economy to somehow help boost demand, and that's been working with questionable results. Exchange rates, clearly for internationally exposed companies, it's extremely important to be able to anticipate where exchange rates are going, and also to for pricing reasons to understand what the impact of inflation will have on the purchasing power of consumers. Then, of course, labor policy, clearly an important aspect that HR managers have to take into consideration. They have to understand what the longer term structural evolution is in the labor market. It's their job to read the signals and be able to anticipate. Fiscal policy, clearly taxes are always of great interest to corporations and individuals alike. And of course, trade policies. Companies generally are looking for more liberal trade regimes across the world because they'd like to be able to have the freedom to buy and sell their services and products and to ship them to other markets. But of course, countries have an instinct sometimes to want to be protectionist and to protect their domestic companies and labor markets. This is why penetrating foreign markets requires the keeping up with reading in terms of what's happening in current events. Then, of course, there's the a knowledge of the banking system. We can't live without banks, and therefore CFOs, people in finance and so on, need to know how banks operate and sort of systemically and structurally, and also what they can expect from their banks in terms of innovative solutions and services to be able to hedge risks and, of course, to borrow to be able to fund their businesses. Here's just a little bit of institutional detail with regard to payment systems which exist at banks. So there's a technical angle as well, which people should be generally aware of. This is directed towards the English system, but of course internationally there's also the payments regime such as SWIFT, which governs the flow of payments across the world. Now, no less important, of course, is the need to understand what the choices are in terms of funding for a business. We'll start with equity, ordinary shares or common shares, basic business units of ownership of a corporation. These are the people, the shareholders, who carry ultimately the risk of a company succeeding or failing. If the company succeeds spectacularly, the rise in share prices will make the shareholders very rich. But if the company fails, then and the company goes into liquidation, its assets have to be paid out to creditors first, and according to a ranking of preference of different claimants on the company, and the shareholders will be the last ones in the queue to get anything. That's why they're referred to as residual claimants. Now, we don't have to be corporate lawyers, but we do need to have a good basic understanding of what the shareholder perspective is with regard to a company. Now, let's move to preference shares. Preference shares are kind of an interesting and rather mixed bag of shares, kind of call it a non-equity form of capital. The preference shareholders are people who provide finance to a company on terms which indicate or reflect a lower risk than the common shareholders, and that's why preference shares are said to rank preferentially to common shareholders. Now, pref shares can be redeemable or irredeemable. Redeemable means that they can be repaid, so it almost has the character of a loan, or they're irredeemable, which means that they are issued forever, and like shares, they're not actually repaid. The dividends that are paid on preference shares are not tax deductible. You can see here that the preference shares somehow, based on the specific conditions that are specified in the pref share, somehow are between debt, sort of pure borrowings of a company, and the common shares of the company. They sort of are presented in the liability side of the balance sheet, somewhere in between those two sort of pure cases. Dividend rate can be participating. Again, this is kind of the having a share in some of the excess profits. Again, likens the preference shares to normal shares. Normally, they do not have voting rights, which means again that they are not common shares. We have to be very clear about that. And interestingly, you also have pref shares which may be cumulative, which means that if dividends aren't paid in a given year, they can, because the company for some reason chooses not to have, not to pay, or doesn't have liquidity to pay, a cumulative pref share has to be caught up, meaning that in subsequent years the missed dividends have to be paid before common dividend payments can continue. So this shows the preferential nature again of preferred shares. It's also interesting to think that to appreciate the fact that preference shares, since they pay a dividend, there isn't an obligation then to pay them immediately. If they're not cumulative, for example, and a dividend falls out in a given year, then that may be lost. Depending on the terms of the pref share, the company can be driven into bankruptcy or be declared in default, as it could be if the company were to miss an interest payment on a loan.